Hi, I'm Jarrad Brown, Australian expat financial planner based here in Singapore. Thank you for tuning into my video today. We've got the end of financial year rapidly approaching in Australia, so it's time to start thinking about our tax planning, particularly if we still have taxable income in Australia. For most of us, that's going to be rental income if we've got a property in Australia that's rented out. Naturally, we still need to be filing returns, or we certainly still should be, and we need to think about what that means, if that's negatively geared, positively geared. Do we want to pay that tax? Can we get rid of it somehow? What do our options look like? So in this video, I'm going to share with you some simple considerations if you do have taxable Australian income for you to think about when it comes to your tax planning for this financial year. So let's dive right in. So your first option, if you have a positively geared property, meaning that the incoming cash flow exceeds the outgoing cash flow. Now, be sure to remember that with your mortgage repayments, it's only the interest component that's deductible, not the principal component. So make sure that you're crunching your numbers correctly there. But if you do have a positively geared property, that means that in most instances, the first $90,000 is taxed at 32.5%. So 32.5 cents in the dollar, we still need to pay the Australian Tax Office. So what can we do to get rid of that? The first option we've got is to consider contributing some money to our Australian Superannuation Fund. Now, what that allows us to do, we can contribute up to $27,500 under the current caps and then claim that as a tax deduction. There is still a contributions tax of 15% that gets applied, so we don't quite get away completely free, and that money is locked up in superannuation until we hit a condition of release. So for most of us, that's going to be age 60 before we can draw that money back out. So make sure you speak to your Australian financial planner, speak to your accountant, certainly do your homework here, but certainly a worthwhile consideration if you have that positively geared property. Now, your second option is to consider prepaying any interest on investment debt that you have in Australia. So if you have a mortgage on an investment property that's rented out in Australia, you can speak to your mortgage broker, speak to your lender, and potentially prepay some of the interest up to the next 12 months to bring forward that tax deduction into this financial year. Now, make sure you speak to your accountant here, review your options, review what's sensible, but it may be a worthwhile consideration to avoid having to pay that 32.5 cents in the dollar. Your third option when it comes to minimising your Australian tax is to consider bringing forward any repairs or maintenance to your investment property. Now here we're specifically referring to Australian property, and we're specifically referring to repairs and maintenance to bring it back to its original condition. So that might mean repainting the walls, it might be improving the fence out the front, replacing the air conditioning, whatever it may mean. Those expenses that are incurred may mean that you can bring forward that tax deduction into this financial year. Now, it's important that you understand the difference between capital improvements, which add to the cost base of the property, and repairs and maintenance, which allow you to claim that tax deduction. So speak to your accountant, speak to your financial planner, and make sure that you're doing the right thing and claiming the eligible deductions in the right way. The fourth item to consider when it comes to your Australian tax return is, do you have a HECS or help debt? So a student loan in Australia from an Australian educational institution. If you do, you need to be declaring your worldwide income to the ATO. You can do that via the MyGov portal. You can check out our other video on how to access all of that and how it all works. But if you do, you still need to be declaring your worldwide income and paying the amount required off your student loan. So gone are the days where we didn't actually need to repay those student loans anymore, so very important that you pay attention to this one. And my fifth and final consideration for you is to simply ask yourself, do I need to be filing a tax return in Australia? Far too often we hear the remark, well, I don't need to be filing a return because my properties are negatively geared. Now, unfortunately, that is not the case, and it's not even close. So very importantly, you're still filing a return if you have taxable income in Australia, even if your property portfolio is negatively geared. It can also mean that you're keeping track of tax credits, you're keeping track of any tax losses that you may be able to claim later on in life. Whether that be selling properties in future, living and working in Australia again, selling shares, whatever it may be, those credits may add a lot of value for you later on in life. So I hope you found these short tips helpful. Make sure you pay attention to your Australian tax planning. Don't simply forget because you're living offshore, and we don't have long. 30 June is the deadline, so make sure that we're getting onto this as soon as possible. If you have any questions at all about your tax planning or anything else for that matter, feel free to reach out to me. Drop me any questions in the comments. Please remember to subscribe. Thank you very much for tuning into this video, and I look forward to seeing you next time.